Greetings, everyone. My name is Kyle McLean, and I'm a partner and senior wealth manager here with Raymond Gorell Wealth Management. Today, we'll be covering a potentially lucrative tax strategy, the Mega Backdoor Roth. This strategy gives employees a way to supercharge tax-advantaged 401k savings beyond normal IRS limits. If you or someone you know could benefit from this strategy or the other services that our firm offers, feel free to contact our team for a complimentary consultation where we will review your financial situation to determine opportunities for optimization from an investment, tax, estate planning, employer benefits, and retirement strategy perspective. Let's jump into today's topic, the Mega Backdoor Roth strategy. So, what is the Mega Backdoor Roth? At its core, the Mega Backdoor Roth is a tax strategy embedded within 401k plans. By undertaking a series of transactions, employees can make Roth 401k contributions well beyond normal IRS limits. For instance, in 2025, employees can contribute $23,500 either via pre-tax or Roth contributions, with a catch-up contribution of $7,500 available if you are age 50 or older by the end of the year. The Mega Backdoor Roth allows certain employees to add tens of thousands of additional dollars beyond that limit annually to their Roth account within the 401k. I'd like to take a moment to refresh everyone's memory on how pre-tax versus Roth contributions work for tax purposes. As I previously mentioned, for 2025, employees can contribute $23,500 to the pre-tax, the Roth account, or some combination of the two. Pre-tax contributions, as we may know, involve making contributions before federal income taxes are paid. However, all of your contributions, as well as growth on those contributions, are taxed as ordinary income upon distribution. Roth contributions, on the other hand, are made after federal income taxes are paid. Therefore, all of your future growth, as well as your original contributions, are tax-free upon distribution. The determination of whether an employee would want to make pre-tax or Roth contributions is entirely dependent upon their anticipated future tax rate versus their current tax rate. This is an in-depth calculation that is difficult for every person, and why we suggest consulting a financial professional, such as our team, before coming to a final determination on which is best for your specific situation. Some 401ks provide a third account, or bucket, called the after-tax account within the plan. This account is what allows us to facilitate this Mega Backdoor Roth conversion strategy. Let's discuss the tax features of the after-tax account, because it's a bit of a blend of elements of both the pre-tax and Roth account tax treatment. After-tax contributions, as the name implied, are made after federal income taxes have been paid from the funds. However, growth that occurs while inside the after-tax account will be taxed as ordinary income upon distribution. For the purposes of this video, let's assume that an employee is making $250,000 and their company is giving them a 7% match, which comes out to $17,500 each year. Based on the example discussed above, the total going into the 401k for an individual maximizing the pre-tax contribution is $41,000. $23,500 from the employee's payroll deductions, and $17,500 from the employer's match. This $41,000 total is well below the total contributions that the IRS allows from any source into the 401k for the year, which is $70,000 for those under the age of 50 and $77,500 for those over the age of 50. So, where can this $29,000 difference between the IRS limit and the other contributions go? As you might have now guessed, it is the after-tax account. However, you might ask yourself, why would I contribute to an account with no current tax reduction, and all of my future growth will eventually be taxed as ordinary income at my highest marginal tax rate? This answer is because we don't intend to leave the funds in the after-tax account to grow indefinitely. Using this strategy, we will convert all of those after-tax funds contributed to Roth. And the best part is that if funds are contributed to Roth before they have time to grow, the conversion is entirely tax-free. How this works is that once you maximize your pre-tax or Roth contributions up to the IRS limit for the year, you may start putting funds into the after-tax bucket. Some 401k plans will do this automatically, while others will require you to elect this treatment for the additional contributions. Subsequently, these additional funds are converted to the Roth account, where you will enjoy tax-free growth until those funds are distributed during your retirement years. Again, every plan is different, with some 401ks allowing multiple conversions per year, while others limit the number of conversions that can be made in any given calendar year. At this point, we hope it's becoming clear that this strategy can be an absolute tax home run for retirement savers. Let's consider a comparison of an individual who fully utilizes the Mega Backdoor Roth strategy over the course of their career versus an individual who alternatively diverts these funds into their brokerage account. Given that the Roth earnings are totally tax-free, while the brokerage account earnings will generally be subject to a 15 to 20% tax rate on long-term capital gains, and an ordinary income tax rate of up to 37% on interest income or short-term capital gains, the differential is at minimum several $100,000 of needless taxes paid. Before we wrap up, I'd like to draw your attention to an important consideration surrounding this strategy. If you currently have a pre-existing after-tax balance within the 401k or growth on recent contributions, you should be aware of the pro rata rule. The pro rata rule states that if an after-tax account contains a mixture of contributions as well as growth on those contributions, any conversion or distribution from that account will be partially taxable, depending on the ratio of your contributions and your earnings. Let's say that over the course of 5 years, you contribute $150,000 to the after-tax account, and this grows to $200,000. Now, 25% of every dollar withdrawn or converted will be taxable according to the proportion of growth within the account. You can combat the pro rata rule by making regular conversions of your after-tax dollars before significant growth can occur. If you have a pre-existing after-tax account balance that contains growth, some 401k plans provide different options to help employees clean the slate, so to speak, and open up the Mega Backdoor Roth conversion strategy. These 401k numbers are different for everyone, so we absolutely recommend that you discuss the effect of any current balance that you have within the after-tax account with a tax expert who can help you understand the tax implications of any future conversions. Thanks again for spending some time with us today to learn about the Mega Roth strategy. At Raymond Gorell Wealth Management, we provide advice on over $1 billion in client portfolios. As a firm, we strive to serve as an effective one-stop shop for comprehensive retirement planning. The many CFP and CPA tax professionals on our staff specialize in helping our clients take advantage of advanced financial strategies to materially enhance their financial ability to enjoy their lives before and after retirement. We invite you to schedule a complimentary consultation with our team today by giving us a call, sending us an email, or visiting our website.